This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
All right, so for our conversation today, we're going to, in the next 20 minutes here, we're going to do some tough love. And it's not even our tough love, it's Mark Cuban's tough love on investors. And how apparently we're being suckers, Abe. You're a sucker and you're a sucker, according to Mark Cuban.
Sometimes we can be. So, yeah, let's hear what he has to say here soon.
It's so deflating despite the good intentions, the best intentions that so many of us have to find out that if we're doing it one way, well, at least according to Mark Cuban, suckers we are. So hang on here with us here on the radio. We'll get to that in just a few minutes. But in the meantime, speaking of things that might make us suckers, things that we're accidentally doing that could cause us harm in the long run, Abe, there was this list posted recently on GoBankingRates.com of the assumptions that people make about retirement and how these assumptions, in fact, can cause some pretty major problems for us down the road. Talking about things like you won't live into your 90s. You'll stay healthy the whole time. Your expenses will decrease. Markets will stay constant, although I'm not sure how many of us actually assume that one. But things like inflation remaining low, you'll be able to work. You'll get an inheritance, apparently, is a common assumption, which I think is about as risky as playing the lottery and expecting that to be your retirement plan.
I've seen it.
Well, thinking about all the things that you do see as a local independent financial advisor here in Ashburn, you've been doing this over 2 decades now, isn't that right?
Yeah, 23 years.
In these years, what have you seen as far as assumptions that we make about our retirement and the harm that they can do?
Yeah, let's talk about some of them. And one of them not on this list that we think might be one of the biggest myths of a retirement plan or in retirement planning is that you're going to be in a lower tax bracket when you retire simply because you're not working anymore and because your income will be lower. That's a huge myth and assumption for a lot of people. For some people, it's going to be true. For a lot of people, it won't be.
Okay.
So just to assume that you're going to be in a lower tax bracket because you're not working anymore and you might have less income. I mean, is that the retirement that we want to dream of? Is that the retirement that we want to aspire to?
No.
That where we have lower income and we can do less than we've ever dreamed of? No.
Right.
In fact, we want more income, more cash flow, more money saved to do everything that we want to do. So huge myth there. You won't live into your 90s or you won't live long. You'll live an average life. And I hear people come in all the time saying, well, my dad passed at 80 and my mom died at 70 and I don't have long life. Well, that you got to take that into consideration, but you also need to probably plan to live a longer life than you think. While you can make educated guesses based on family history and your lifestyle, always factor in the possibility that you might live much longer. You will remain healthy. Another one, that you'll stay healthy. Healthcare and home care needs could greatly diminish your retirement savings faster than you think if you became sick. And obviously, the longer we live, Heather, the greater the chance is that we are going to get sick or need some type of care in our home or nursing home, that type of thing. Our expenses will decrease. Well, that could be true somewhere in retirement, but what we see here at Abich Financial is that first 10 to 12 years, expenses increase. Because remember, you're punching the clock, you're retiring, you want to go do everything you want to do when you're healthy and able to. That's where you want to spend in those go-go years. And yes, maybe expenses will decrease later, but they could also increase again in your later years for healthcare. Markets will remain consistent. In other words, if you're pricing in or you're expecting like an average, 6% or 7%, whatever return it is you're looking for, and you think markets are going to remain consistent, and you invest in your accounts, your portfolio, and a balanced portfolio, and you'll get a consistent rate of return, you might have a problem if markets hit a rough patch, right? And we have a negative 20 or whatever it is. Inflation will remain low. Well, it may not always remain low, and we saw that really spike the last handful of years. You'll be able to go back to work. Come on. Is that what you really want?
Right.
To go back to work when you've already retired? Yeah, you probably could. But actually, a lot of people couldn't. Even if they tried, they might not be able to get hired again.
Right.
Finally, I'll receive an inheritance and everything will be okay. Well, man, I'd hate to be that person that's kind of banking my retirement on money that I could or may
Like I said, that sounds to me like betting on winning the lottery. It'd be great if it does happen, but you shouldn't be planning your retirement around it.
Yeah. So a lot of those common assumptions we see a lot of the times. And we just helped a couple out of Herndon, Virginia, about 4 million accumulated. Been working with a phase one firm now for, I don't know, 10, 15 years, and has had what we call a phase one plan. That's that accumulation focused, investment focused retirement plan, because they haven't retired or hadn't retired yet until they met us. Wondering if they could retire. I mean, here's a couple with $4 million, a couple Social Security checks. Yes, they could retire, but their phase one advisor wasn't helping them by showing them how they could retire, because when the conversations are solely focused on rate of return, here's what you made last quarter, here's what you made last year, here's your 5-year average annual return and 10-year average annual return. And if the next 5 or 10 years are like the last 5, 10 or 10 years, then you're probably going to make 7% a year, whatever it is.
Yep.
That's not a retirement plan.
Right.
Right. To just focus in on the investments. The investments are super important, but one of maybe 6 to 7, comprehensive pieces, right? In a comprehensive plan. You've got your healthcare and your taxes and your estate plan and your income planning and your insurance planning, and when to take Social Security and how to handle RMDs and how to handle charitable giving, how to handle healthcare. All of these things, and way up at the top is, well, I've got $4 million. Here's a couple with $4 million. How can I enjoy it? We put together a phase 2 comprehensive retirement plan for them, which takes all the assets and all the money and shows them how they can spend it and enjoy it without the fear of running out. Look, there's always going to be risks, but if we now have a plan for our 60s, 70s, and 80s versus having a plan for when we're 30, 40, and 50, it's very different. We put that phase 2 comprehensive plan together for them. We want to do the same thing for you. If you're 55 years old and older, you've saved $500,000 or more in investable assets that we can help you with. We want to do the same for you. We want to help you put together your own phase 2 comprehensive retirement plan.
All right. If you're an investor of really any kind, even if you're not, the name Mark Cuban, maybe you just like reality TV or basketball. The name Mark Cuban is one that many Americans are familiar with. Entrepreneur. Which basketball does he own? The Mavericks? What is he?
Dallas Mavericks.
Okay. Mm-hmm. NBA basketball team owner. He's a billionaire, right? He's at least a very many 100 millionaire. Mm-hmm. Shark Tank investor. Mm-hmm. He's got some tough love to give us investors, Abe. He was talking about and talking to people that passively put their money into the stock market. And Mark Cuban says that the term buy and hold is the most misleading marketing slogan ever. He says, it's fine to have a long-term horizon for your money, but the idea that you can put money in and expect it to grow without management is for suckers. I got a couple of things on this because we have talked before about the importance of letting your money grow and the value of compound interest. I mean, that's what Warren Buffett preaches and practices, right? So what do you think of this perspective? And I guess maybe is there just somewhere in between that we need to be working and living in?
You might have pieces of your portfolio in retirement that could have or be taking a buy and hold approach, right? Maybe you have pieces that you say, you know what, Heather, I'm not going to need this money. I'm not going to spend it. It's solely for my kids and grandkids. It's solely for my church or whoever. And you've got pieces of the portfolio where you're like, I can buy and hold. I can hold on to these positions for a long time and I'm not going to need it. And, we might be able to do that leading up to retirement, right? Just kind of, take a back seat, stuff your accounts, max out your accounts, get the matching contributions, not pay too much attention to them. Although other than like we're saving everything we can, kind of let the markets take it from there, not be too worried about making, changes. And then we get to the point of retirement and you've got your 5 million saved, you've got your million saved, your 10 million, whatever it is that you need. And you realize, well, I've got a lot of my money in NVIDIA and Palantir and Amazon and Microsoft and all these companies that have done really well, and I don't really want to sell them, but I've gotten to my number. I mean, we see this predicament all the time, and these are these buy and hold people that think these 5 or 10 companies or whatever it is that they're holding is going to get them through a successful retirement. But in retirement, at the point of retirement, everything changes because you want income. You want to enjoy this money that you've accumulated.
Right.
So naturally, the plan should start to change and to shift. And Mark Cuban points out, Heather, that when unexpected expenses happen or hit, whether it's a job loss, a medical emergency, or just life happening, most people don't have the option to wait out a market downturn. So what if you're holding companies like that you love, markets take a 20, 30% hit, you're forced to sell stocks when the market's down, you may never recover from those losses. And if that happens at the point of retirement, or those first 5 to 7 years into retirement can be absolutely crushing.
That's the sequence of returns risk that we talk about a lot, right?
Sequence of returns risk.
Okay.
And sequence of returns risk is the risk to most retirees that when the markets are down and you're withdrawing out of your nest egg at the same time, you have that double negative and double whammy that might not ever be able to be made up because you need continuous income year after year.
Yeah.
You don't want to go back to work, or you can't go back to work, right?
Yeah.
So we just had a gentleman come in from Great Falls, Virginia, $10 million saved, 5 to 7 of these Mag 7 really popular stocks, some of them I just mentioned, that he loves, that have done extremely well. And it's been really hard for him to realize, well, they've done extremely well, but my plan needs to start changing from pure pedal to the metal, pure risk, pure octane. Like, these companies are some of the biggest companies in the world. They've done extremely well. Let's realize all that growth. Let's realize how well we've done and start to change the plan from pure pedal to the metal to growth and income, from just growth to growth and income. And so we put together a portfolio x-ray for him and realized, wow, you've got your entire life savings in 5 to 10 companies. That's got to change. Any financial advisor, or most financial advisors that are helping people in their 60s, would recommend that as well.
Yeah.
Reduce the risk, take on appropriate risk for this next season of your life. If you're 55 years old and older, you've saved $500,000 or more in assets we can manage. We want to help you put together your own portfolio x-ray and analysis as well, so you can understand what you hold, what you're investing in, the pros and cons. And that x-ray and that report's been extremely helpful for a lot of people across the DC metro area.
Abe, a new study came out by Natixis talking about the top questions people are asking their retirement planners right now. So I wanted to ask you about these questions. Are these questions you see? Are there other questions that you think we should be asking? Am I protected from a downturn? What do I need to do to outpace inflation? Am I going to meet my goals? And how do I preserve and pass on what I build? Were the top questions according to this survey. So what are you seeing from folks in your office?
Yeah, perhaps more simply, a couple of common questions we get almost every meeting when a prospective client is considering working with us.
Yeah.
Do I have enough to retire? Quite simple, right? And when can I retire? Can I retire now?
Okay.
Because I'm thinking I need to wait till 65 or 67. One of my personal greatest joys is to get people retired sooner, sometimes several years sooner than they maybe had thought they were going to retire.
Sure.
But from the article as well, 84% of financial professionals say their clients are most worried about being protected from a downturn because investors worry about whether rallies over the last few years are sustainable. I just got this the other day too, just concerned about markets hitting all-time highs. United States advisors say the biggest risks they see for clients today are letting headlines interfere with long-term strategy and a tendency towards trying to time the market. And I have seen this, we have seen this often.
Yeah.
You know, when there's volatility, sometimes people want to sit on the sidelines. It is time in the market long term, not timing the market. We don't want to do that.
Right.
Because you won't get it right. More than likely, you will not get that right. But if you're in the market and you have a long-term plan and that's what you focus on, you're going to be there for the highs, the lows, and it's all going to average out, hopefully, to a return that meets your needs. So we just had a couple from Fairfax, Virginia come in with about $4 million. They're retiring in about 3 years. So they're about 62 years old, retiring at 65. $4 million saved, just a great job of accumulating and saving. But concerned, right? You know, $4 million is a fantastic job of saving and putting money away, and they're going to continue to do so the next 3 years. But they're also thinking, hey, you know, this gentleman's mother is 94, still kicking and still doing really, really well. In fact, they travel. She's able to get up and down the stairs. She flies, you know, out to the West Coast, 94 years old. Yep. So I said, you know what? We need to be planning for a long life for you guys as well. And so that's the plan. So they've got the $4 million. We need to continue growing that to get it to last probably another 30 plus years. But at the same time, we need to protect it while being flexible, right? We need to protect it from all the major risks like taxes and market downturns. We need income. This family is retiring in 36 months or less, 3 years or less, making, you know, maybe $300,000 or $400,000 a year. All that wage is going to go away. The income needs to be replaced from Social Security, maybe annuities, pensions, and the entire stock market portfolio. Okay. But as you get closer and closer to retirement, you really need to start thinking about that mindset shift and switch from pure growth, pure accumulation to growth and income, because that's the phase of life you're going to be in. We laid out a retirement income plan to show them how to do just that. They consolidated most of their assets, built together a plan with us, and they're very, very comfortable. If you want that added confidence in building out a retirement plan you can be comfortable with, pick up the phone right now. If you're 55 years old and older, you save $500,000 in investable, manageable assets that we can help you with. We want to offer you the same retirement income plan complimentary.
Abe and his team, they're here to help you do that. So it's theretirementkey.com to start the conversation, or you can just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.